Now, when we say a financial system, it is an integration between institutions and markets. The key components of the financial system are the financial institutions on one side and the financial markets on the other. The interplay here is these financial institutions render a host of financial services through different financial instruments, and they operate in the financial market. So, financial institutions and the financial market through a host of agencies which provide services through instruments that help in transfer of funds and transacting of funds is what we talk about when we look at a financial system. So, I think we need to look at this financial system closely. We need to examine this financial system that we have today vis-a-vis the financial system which perhaps existed 50, 60 years back, or even vis-a-vis the financial system that was there maybe 100, 200 years back. And you will see certain very predictable, clear changes that have taken place. And something that we can understand very clearly at this point is that the change is on two fronts. One is from a segmented market, we are moving into an integrated market. And another one is from a regional kind of market, we are moving into a global kind of market. So, anything that happens here is based on these two factors. And let us try and understand more about the financial system by looking at its components at large. Let us try and understand the functions of a financial system. Now, it is based on these functions that we assess, we evaluate how effective is our financial system. The first and foremost function perhaps would be the financial system always attempts to create an very effective and efficient payment system. We need to have a financial system which ensures payment for the movement of goods and services. And this is one among the functions of a good financial system that we have. A financial system should support pooling savings from the household sector, because always there is a diverse between those who save and those who invest. The financial system essentially must pool all the savings from those who save and ensure that the same goes into the hands of those who need to invest. This is how it supports economic growth and development. So, investors are those who try to ensure production, employment, income generation, and that creates savings. Savings are pooled again to see that it is channelized again into investment. So, the link between the savers and the investors will definitely be the financial system that we have. Another important function would be to ensure deployment of funds, because when you have all your funds pooled together, the very objective of pooling this is to see that it is channelized into desired sectors of growth. So, you are deploying funds, both government as well as business organization, they deploy funds which come from the financial market in a wise manner, and that is exactly what is done by the financial system. Another important function would be to impart liquidity. All those who have saved money are saving this in anticipation of a return, and logically this return should match or be greater than the rate of inflation. So, when they save, they expect something in return, and it is not just an expectation of mere return, they want to ensure that they get it when they need. So, the financial system must ensure liquidity in terms of getting back the money when needed. Otherwise, those who save and those who invest, if they see that this flow is not consistent, they are not actually interested in again reinvesting or redeploying funds. So, ensuring liquidity in the economy, ensuring liquidity for the savers, ensuring liquidity in the use of funds for the investors is another objective of your financial system. Again, you support risk management, because in a financial system, that is where you look at the financial market today, there are some products which are highly risky, some products which are less risky, both for individual investors as well as for institutional investors. Now, based on my risk appetite, I need to select my investment opportunities, and the financial system supports that. Say for instance, if I am happy with a low rate of interest, I can put my money into a bank. If I want a higher rate of interest, I can go into the equity market. And again, in the equity market, if I don't want to take that levels of risk which is there in equity in a direct form, I can go for derivatives. So your market should be such that it accepts, it supports debt, equity, deposits, insurance, mutual funds, a host of products, and you are managing the risk at such a level where you can decide what proportion of your funds can go into the different avenues based on the risk appetite that you have. Similarly, the investors, when they are subjecting their funds, hard-earned money for different projects, they need to manage risk that comes out of the project in terms of the cost of funding and in terms of the benefits that come. And this is again possible when you have a good financial system with you. You also look at investment opportunities. The financial system creates investment opportunities. Say for instance, if I have a host of mutual funds, I am not quite sure of selecting my own investment opportunities in terms of equity, I can go for mutual funds, which is sectoral, which is industry based. I can look at, that is an opportunity that I have. I have opportunity to invest in fund of funds. I have opportunity to invest in exchange traded funds. I have opportunity to shift between funds. I have opportunity to invest in commodities. I have opportunity to invest in global traded funds. I have opportunity to invest in just trade receipts. So the market is so diverse. The market is so surplus with opportunities to invest, wherein you can think of what return you want, how you plan your investment horizon, and you have supportive investment opportunities if you judge well, if you examine well what exactly can be done over there. Again, the market, the financial system again is ensuring that there is a proper system to get price information, because we today talk about a market which is highly transparent. So whatever price prevails for different services, whatever opportunities that exist, this is very clearly given to the potential savers, to the potential investors from your financial system. So this role is played very effectively over there. It also ensures, the financial system also ensures efficient allocation of resources. Whatever you earn from the savers, which are the sectors in which it need to go, what part of it has to go into infrastructure, how much of relevance you need to give to the service sector, what is the importance that you give to the MSME sector, what is the support that you give to startups. So allocation of resources based on priority of the economy, allocation of resources based on events which happen globally also takes place as a very good function of the financial system. It also, and through this, ultimately, the final objective or the final goal where the entire functions of the financial system takes its culmination is the support for the economy. As we said earlier, when I am pooling the funds of those who save, when I am giving it for wise investment to the investors, the objective here is to ensure that it creates better production, and more production will definitely create more employment. More employment would obviously create more income, and this will boom up the economy. You will have economic growth. Contrary to this, if the funds that you save do not go into investment, productive investment, there will be less production. Where there is less deployment of funds, there is less production. When there is less production, it will have an impact on employment. It will have its impact on income generation. It will have its impact on further savings. So when you look at financial system and economy, you will see that there is a direct relationship in everything small and big that happens there. And today, when we discuss the contents of this course, we understand that none of these segments today are insulated. insulated within the segments of the market and insulated between the markets of different nations. So today we need to have a look at the market. When you closely observe, you will see all events which are global have its impact on India. All events which take place in one segment has its impact on another segment. And this is how the relationship to the economy comes. And that is where we need to understand the dynamic change, the complex change that has happened in the financial system. A few examples. If you look at what happened in the subprime crisis, even though the subprime crisis originated in USA, it had its impact in India because we saw FIIs, a host of foreign institutional investors withdrawing money from the capital market. Our indices collapsed significantly. If you look at what happened very recently, the volatility in the Indian capital market, it has happened because of certain events affecting a small segment, but its impact is its spillover impact is quite wide. Say for instance, in the last budget, we had a proposal for a surcharge on the super rich, those who invest in the security market, the foreign portfolio investors, and those other investors who invest beyond 2 crores of their investment, they have to pay us a surcharge. Now, this decision created a turbulence in the market. There was a withdrawal by foreign portfolio investors to the tune of over 12,000 crores in a short duration, and our Honorable Finance Minister came up with a proposal that this is currently being kept at the bay. We are holding it for the time being. Now, this we saw how it impacts the market. We saw how the subprime crisis had its impact in India. So, an event in India which is getting affected by withdrawal of foreign portfolio investors in our market. Similarly, an event in US where they had a subprime crisis, it's affecting India. So, anything that happens in any part of the world has its impact in the Indian capital market. Again, anything that impacts one particular segment. We saw when the NBFCs had a huge exposition to banks, RBI intervened and they put some caps, and that had its impact on the movement of funds. Something that happens in insurance does not stand in insurance alone. It has its impact on banks, it has its impact on the capital market. So, the lesson that we learned from this is the segmented kind of insulated impact, regional impact, which the financial system had, today no longer exists. Which means all over you will have a cascading effect, all over you will have a spillover effect, and to get that corrected, we need to have a financial system itself which is sound. So, we cannot just say that our banks alone can be sound, or insurance alone can be sound, or mutual funds alone can be sound. We need regulations in place, we need standards in place, we need clear-cut objectives, managerial systems, governance in place to see that the entire financial system is supportive to the economy, to the nation. And this happens only when we are vibrant in terms of productive investment, which supports employment generation, income generation, and it keeps cycling. We need to have a systems approach there where you have inputs which are processed, outputs which are given, and the output again becomes the input to the next system, and it continues to flow on that line. So, the efficiency in the use of funds talks about the pace with which it keeps moving and the pace with which it gets observed into the economy, and that is where the financial system ultimately supports economic growth. Now, at this stage, when we look at the financial system, any investment management system focuses on 4 pillars. Number 1 would be return, the second would be risk, the third would be liquidity, and number 4 is safety. Now, this is something which is known to all of us, including those who are learners in the field of finance, commerce, management, and so on. And the financial system is in fact responsible to keep these four pillars balanced, or to have your markets, the financial market, to have your services, to have your instruments, and to have your institutions taking care of these four pillars. Now, often what happens as an ordinary individual or a layman, if you look at organized versus unorganized market, what we find is you are driven by only one of these pillars. An institution or a service tries to focus on return alone. We offer this much return, and we are trying to pool all savings on that line, talking about returns alone. That is how many of the private money lenders and all source fund. So at that point of time, we ignore risk, we ignore safety, and we ignore liquidity. Now, essentially, when you are talking about banking, when we are talking about insurance, when we are talking about mutual funds, when we are talking about capital market, be it debt, equity, derivatives, or any innovative product, there must be a perfect blending between these four pillars. When we look at return, we cannot give a return that does not justify the risk associated with it. We cannot ignore the risk involved in that return generation. Similarly, we cannot ignore the liquidity concerns, that I gave money or we have invested money, but there is no idea when you are going to get back cash. Again, very carefully, we need to look into the regulations in place. If you look at all systems that have failed globally, including those of USA, we find the Indian system to be reasonably good, whether it is in the capital market, whether it is in the banking sector, whether it is in terms of the Basel Accord, whether it is in terms of the Association of Mutual Funds of India, the Securities Exchange Board of India. They have clear-cut regulations in place. This does not mean that we don't have insider trader or everything is perfect, but by and large, we have been giving due importance to safety. Regulations in place, standards in place, and it is these standards, these regulations, these protection mechanisms that we have under our regulatory bodies that have managed our pillars to be kept intact. So, essentially, the financial system, your institutions as well as your markets have to have a clear-cut balance on these four pillars with which you manage. Now, what are the components of the financial system that you have? Number one is the institutions. Now, we have institutions which in the subsequent units that follow, you will see the different kinds of institutions, including stock markets, banks, and so on. Broadly, they are classified into specialized and non-specialized financial institutions. Even banks, maybe 20, 30 years back, when you look at the history of banking after nationalization, banking itself had specialized institutions. Agriculture banks, which was focusing only on agriculture finance, Exim Bank, export-import trade, banks for SSI financing, banks which were concentrating on only one line of activity. So, we had specialized institutions which were providing credit on a given line, derivatives which had only a specialized line of operations. So, you have specialized financial institutions and you have generic financial institutions in that line. You have banking institutions and you have non-banking institutions, what we call NBFCs. There again, we have to look at the market. When you are saying banking institutions, they all come under the Reserve Bank of India. When you take non-banking financial institutions, there are a host of institutions with multiple regulators. Say for instance, you have cooperative banks, you have housing finance organization, you have venture capital firms, you have even money lending for different kinds of specialized activity by NBFCs, which are not always regulated by RBI. So, banking and non-banking institutions are there with you. Again, you have foreign institutional investors and domestic institutional investors. Now, they keep moving across the globe in different financial markets. So, where they enter, the market shows a boom. When they withdraw, the market retrieves and goes down. So, such institutions are also there over you. Now, you have financial markets. First, we saw the financial institutions. The second important component of the financial system is the financial markets that you have. Here again, you have organized and the unorganized markets in place. Now, when we say organized markets, they have regulators, they have regulations, they have trading principles, they have activities which have to be carried out in a very organized, formatted with formal trading systems. Now, there are unorganized financial institutions and markets also, which they don't have the same kind of regulatory framework, they don't have the same kind of guidelines with which they move. So, you again have markets of those kinds. Now, you have financial instruments. Now, these instruments, they facilitate transfer of funds, they facilitate transacting in funds, and they are highly innovative in nature today because they vary in tune with the broad category to which they belong. Whether you are in debt or whether you are in equity, whether you are in derivatives, you have, if you are in the derivative segment, you have futures, you have options, you have forward trading, you have hedge funds. As I said, you have fund of funds, you can trade in indices. So, all kind of innovative instruments are there in the market which act as the components of your financial system. Now, you have a host of financial services which support different kinds of activities. You have lease financing, you have hire purchasing, you have merchant banking, they do merchant banking services. Again, you have credit rating, you have depositories who do the depository function specifically when you are doing your demat trading with you. You have venture capital financing, they just look at high risk projects. They venture into the high risk projects and give you finance. So, high risk, high return kind of project financing takes place there. You have crowd financing, you have financing for the micro, small, medium enterprises. So, all kinds of support services do exist there. Again, you have factoring, where what you do is you sell on credit and the parties who purchase from you, you transfer them to a financial institution, they will take care of your debt collection. You have underwriters. These underwriters, they do guarantee the minimum subscription for you. You have loan servicing taking place. You have securitization where you sell your borrowers to another party who will manage it for you. So, a host of financial services are there in the market where we try and see how this market can be kept robust, how you utilize these services for deployment of funds, for transacting funds, for ensuring movement of funds, for servicing the segments in your business unit. So, what then is the financial system? From the components we saw, it is a combination of institutions, it is a combination of instruments, services and markets. Together we say it's a financial system. And there the word that we have used is, it is a system. And literally, it needs to act as a system, because when we say a system, we keep in mind the fact that a system need to essentially have inputs, processes and output. Here the input would be finance sourced, the processes would be based on the nature of operations of the institutions, whether you are a bank, whether you are an NBFC, you are a stock exchange, you are an insurance company, you are a mutual fund organization, the funds you manage will be in tune with your processes. So, inputs will come here. The different institutions have their own layered sequential processes and they give output. Output should be productive, output should be supportive for the economy, output should be sustainable, output should be inclusive. And that is where you look at the growth of the economy. And how do you ensure this sustainability, inclusiveness and productivity of your output? It is when it supports yet another system. So, it simply means I procured funds as a bank or as an NBFC or as a stock market exchange or as a mutual fund. If I did not deploy it in such a way that it has resulted in further production, further growth, further employment, it means that it is not supporting yet another system. So the word that we are using here is we need to have a clear understanding of what is a financial system. Now, all these organizations are not watertight compartments. All these institutions, services and instruments in the market are not watertight compartments. They all have mutually supportive roles. So, the way we understand the financial system must not be in a form where it is something that stands alone, something that is not correlated. We need to understand it in a holistic purpose, because for some, perhaps financial system is just institutions. For some, it is just the market. For some, it could be a few instruments. But in fact, these are all correlated. Now, from them, or from these points, we try to understand what exactly is a financial market. What exactly is a financial system? Now, this is a well-connected and a supportive system where we have agents, where we have institutions, where we have practices, where we have markets, where we have instruments and services, and what they do is they all ensure that there is a desired movement of funds for a productive, for a useful purpose. If this intention is lost, we basically identify the inherent weakness which exists in our financial system, where these agents, these institutions have a very good interplay under very regulated conditions with very refined objectives. Then we talk about a financial system which is very healthy. So now, with this backdrop of financial system, let us further try and understand more about our course, which is specifically on the financial market. So from now on, we take off with a specific element of financial system, which is the financial market.